So as we close out the year and enter the final quarter of 2021, another year that has plagued us with the boring Miley Cyrus, everybody is on the look for a good bargain. Whether you're shopping for Christmas for your wife or your girlfriend, pray those two people never meet, everybody does love a good discounted sale, and it is no different with the stock market. What two companies do I feel that are good value, that if you bought them today and held them through to 2022, you should do quite well? Now, these two companies I do feel are very undervalued, and in both cases you should more than double your money if I am right. And I know that's a lot of speculation and a lot of hype, and no, I am not talking about Alibaba. That would be too easy, and I've done multiple videos on it. So I actually thought that I would give you two stocks that are sort of flying under the radar that I am extremely bullish on. And again, it's not Alibaba or in fact any Chinese play. Both of these companies are from the US and listed on the US exchange. So if you want to find a company that is undervalued and flying under the radar, which you could make decent money on, then this might be the video for you. Now, speaking of Christmas, as time goes by, my beard is getting more grey, and soon enough, I'm going to get the call up and become the next Father Christmas. So if you want to stay on the nice list, make sure you have hit that like button until it turns blue. It would greatly help me out with the YouTube gods. And if you want to join a community of like-minded investors, all you've got to do is sign up with eToro on the pinned comment, deposit, make a trade, and you do indeed, by using that link, get lifetime access to the LWT eToro chat room. Now, these two stocks, like I said, I do feel they're flying really under the radar, and they're two companies that not many people talk about because they're quite boring companies. They don't have crazy technological advances with AI. They're not in e-commerce. They're just two very well household names that are very undervalued. That's the only way of putting it. But I do want to stress here that buying these two companies will not instantly make you a millionaire. I mean, it could if you put enough money on the line, but I think you'd be crazy to, because if you can afford to put that much money on the line to make $1 million, well, you probably shouldn't be on YouTube. You're probably on a yacht somewhere sailing around the Caribbean. But the point I'm trying to make is make sure you do your own due diligence. This is just my personal opinion, and you need to make your own investment decision. A lot of people tend to just buy stocks because some bloke with a beard or some guy called Stock Mo has said it's going to the moon. You need to do your own research. Get up out of bed, brush your teeth, and then go and do your own research. Now, kicking off with a stock that I feel could 2 or 3x just on its current valuation alone. A company that is in the entertainment sector. It's had a crazy ride over the last 12 months and has been a popular company on social media. A company that has been talked about more on social media than probably in its entire history. Of course, I'm talking about AMC Cinemas. This company, I feel, is going to go all the way to, I can't even say the moon. I'm completely joking with you. I'm pulling your leg. Don't click off. I'm not talking about AMC Cinemas. If you're buying that, well, best of luck. You're probably going to need it. I am talking about an entertainment company that's had a crazy 12 months and has had a lot of social media attention over the last 12 months. But I'm talking about Discovery, ticker symbol DISCA. This company, everybody probably thinks boring Animal Planet. David Attenborough can put you to sleep. This company is probably going to stagnate and go nowhere, but you couldn't be further from the truth. If you look at the financials of this company, it's actually epic. I can't think of a better way to describe it. Let's have a little dive in to DISCA. If we look at their overall revenues from 2016 to 2020, we can see that it has gone from 6.5 billion in 2016 to 10.67 billion in 2020, and it is on track to beat that 10.67 this year as well. Then the most important metric I tend to look at, which is their average free cash flow over 5 years. What this is it's the average free cash they have left over after all their bills are paid in the bank. What they can do with this cash is they can buy back shares, give a dividend, or acquire new businesses. This is a very important metric if you're looking to find a company that is going to grow in the future. Now, what I like to do here is take 5 or 6 years average free cash flow, add them all together, divide them by the 5 or 6 I've used, and then I get an average price. And the average 5-year free cash flow from 2016 to 2020 of DISCA is coming in at 2.1 billion US dollars, which is a lot. It is really, that is a lot. 2.1 billion US dollars average per year of free cash flow in a company that's total valuation is 13 billion. That is a hell of a big percentage. Now, what I like to do here is I like to times this number between anywhere from 15 to 25. 25 would be something that is offering crazy growth, something in e-commerce in China, something along them lines that I feel has much more potential of growing at a much faster rate. We've just said David Attenborough puts you to sleep, so we're going to be very conservative and pick my 15 number. The lowest of the low and the most conservative of the conservative on free cash flow from my own personal calculations. So we're going to take this free cash flow average of 2.1 billion, times it by 15, and that should give us a fair value price for this company on free cash flow alone. And that comes in at a staggering 31.98 billion US dollars. The company is currently valued at 13 billion. That's way more than 2 times fair value at its current price. That's just going on free cash flow alone. Of course, we need to look at a lot more metrics, but that is staggering if you're a free cash flow nerd like myself. If we then look at their PE ratios, which again determines value, we can see they have a PE ratio of 15, which is decent as well, given the market is so high in terms of PE, and their PEG ratio is pretty decent as well, at 0.65. And then if we want to look at other people's opinions like analysts, we can go to tip ranks, and we can see out of the 8 people, their average 12-month price target for DISCA is coming in at 39.29, which represents around about a 52% upside. So that even the analysts are quite bullish on this ticker. Personally, I think it's a little bit more undervalued than 52%, but that's just me alone. Maybe it's going to go to the moon. I don't hate saying go to the moon. Hopefully it doesn't go to the moon. It just goes up a lot more than 52%. Now, it wouldn't be fair if I just said go and buy this without talking to you about the 2 downside points, or 1 potential downside point and 1 definite downside point. The first biggest downside point is their dilution. They've added about 30% to their stock float over the past 5 years. So that means if you bought it 5 years ago, you now own 30% less shares. Now, this really is a big worry. I absolutely despise dilution and like to see a company buy back more shares, like the second stock we have in this video. But DISCA has actually been diluting investors, and you really need to do some more research as to why. But this really is a big negative. But nonetheless, I think the positives of free cash flow still outweigh that factor by a lot. If we look at the other news as well, there is going to be a new company. DISCA will probably merge with a new company, Time Warner, which is owned by AT&T. These 2 companies are said to merge together, and DISCA shareholders will own about 29% of the new company, which does sound a bit bad if you think about it like that, but it could be good long term, because as these companies merge together, you've obviously got the great brands like Animal Planet and Discovery, what Discovery already owns, but then you put Time Warner together as well, which owns things like CNN, Cartoon Network, TNT. You now have a much bigger brand, which can then move forward in the future and move more into online streaming, which is obvious everybody is much more a fan of than buying your regular cable TV. So I think these 2 companies merging will be good for shareholders going forward, but just bear in mind, when they do merge, your shares will probably change dramatically. So DISCA, I feel, is good value either way, whichever way you look at it. Other than the dilution, I can't really see much reason not to buy this company. But just be aware, with this news of the merger, the share price can be quite volatile, which I like, because if it goes down a hell of a lot, it means I'm going to buy more at a much valued price. So have a look at DISCA. I think you won't be disappointed. The more metrics I look at, the more I like this company. Now, before we move on to the second stock, if you want to see my full portfolio and what I'm buying and selling as it happens, you can check out Patreon down in the description. There's some cool perks there, including actual buy and sell alerts in the WhatsApp group. So if you're into that kind of thing, go and check it out in the description. Now, before we move on to the second stock, if you looked at the chart on this stock, it would scream to you, don't buy this stock, it's not good value. But honestly, I wish I found this stock a lot earlier, because I did write it off as well. I thought things that you're probably going to think when I tell you the name of the company. This stock's going to die. It's going to slowly die a slow and painful death, because e-commerce is taking over. This company is a very well-known name that has shops all around the world and sells trainers. I know you're probably thinking it was Walmart. No, it's Footlocker. Footlocker, I feel, is very, very, very undervalued. And I'll tell you why. If we look at their revenue from 2016 to 2021, we can see that it is pretty stagnant. It's pretty boring. It's gone from 7.41 in 2016 to 7.55 billion. Why am I interested in this stock? It's clearly growing at a very slow rate. But here's where it gets interesting. If we look at their 5-year free cash flow, like we did with the previous mentioned stock, we can see their average 5-year free cash flow is coming in at $625 million. US dollars. And if we be conservative, because again, it's a dying company that sells shoes in shopping malls which are empty because of the Miley Cyrus, we can see that a 5-year free cash flow times by 15 is coming in at around about 9.36 billion on the free cash flow valuation alone, being conservative. The current market cap for the company, though, is 4.8 billion, which warrants nearly a 2% upside. Again, being very conservative, and I'm not that conservative with this company. I'd actually like to times this one by 20 and be a bit more aggressive, because I feel this company is structured in such a good way that I do not think you can be very conservative with it. Yes, their revenues are stagnant, but imagine if this company doubles down on e-commerce and buys more brands, and it's got the free cash flow to do it, clearly, then this company has a lot of potential in the future. And here's what I'm talking about. If we times this by 20 instead of 15, this then turns into a 12.49 billion US dollar market cap. And again, the current market cap is 4.9 billion. This warrants some crazy upside for a company that everybody knows, Footlocker. They have a super low PE ratio, which again determines value at 4.81, which is mental low given the current market. And if we jump over to tip ranks, 14 analysts give it a 12-month price target of 71.93, which represents a 54% upside. Personally, again, I think the analysts are way wrong on this one, and it could go up a hell of a lot more if the fair value does catch up. But one of the metrics that really stumbled us down with DISCA was the shares. How much shares is Footlocker diluting its investors with? Well, none. They're actually buying back shares with their free cash flow, which is why I like it. If we go from 2016 to now, they've bought back about 25% of shares outstanding. So that means if you bought Footlocker in 2016 and held it every year, you've made roughly around about another 5% every year of ownership. So that means you own more and more of the company as they buy back more shares. And I think they're going to continue to do this. This is the sign of a great, well-run company. I think Footlocker have sort of sat there and said, what do we do with the free cash flow? Rather than go and invest it because they might not feel there's a good investment out there, they've gone and bought back shares. I think this is a great, great sign of a company. But don't be afraid if they do slow down buying shares, because they may just buy some other company and become a much bigger company in terms of footprint. So again, I am really bullish on this company, and I hope that it falls even further so I can get a much better average. But I feel if you bought both of these companies, you've got a good probability of outcome. But again, go and do your own research. Now, what's the key takeaway here? The key takeaway is you can actually double your money potentially on companies that you know of. The companies that are not struggling, like AMC, with movies not coming out anymore and going on streaming services, or have even been closed and racked up mega amounts of debt. You can buy companies that are household names that have been continuously generating revenue that, simply put, are just undervalued. I feel that's the key takeaway, and people really need to start waking up and trying to find more stocks that have good fundamentals and good balance sheets. And I promise you, if you can do that, you will have a much better chance of becoming successful as an investor in the future. You do not need to follow the hype train and buy companies like GameStop or buy even cryptocurrency to become a successful investor. You can double your money with some good companies with good, safe, solid balance sheets. You don't need to rely on hedge funds, you don't need to rely on short squeezes, and you definitely don't need to rely on Reddit. If you understand this mentality, or are even trying to understand it and grow as an investor, you can drop the code word down below, which is value investing. If you could drop that down in the comments, it would massively help me out. And if you want more videos like this where I break down more just on value, again, let me know down in the comments. And if you want to know about Alibaba and why I didn't really put it in this video and why you should really look at buying it, check out that video up there, and I'm going to go through why I feel Alibaba is probably the biggest opportunity of the last 10 years. So that's it from me. Make sure you have smashed that like button, and I'll see you in the next one. Take care. Peace.